master for the harmonic scanner and for the harmonic pro. I'm as excited as always to be able to present and prepare information and education to help you guys excel in these financial markets. Now, today we're going to be beginning the Forex Beginners Bootcamp Day 3, ladies and gentlemen. And today is going to be a big day, as day 1 and as day 2 prepared a lot of information in the market for you to be able to take in, internalize, and learn. Now we're going to begin the actual chart work. Today, we're going to be getting into actually marking up the chart, understanding the highs and the lows, the market structure, the trends, the counter trends, right? Actually reading the price and creating price predictions, which can be very, very exciting for many traders. So what we're going to do is we are going to begin today by taking a look at TradingView. All right. So what exactly is TradingView? TradingView is a web-based charting and analysis software, both available in free and paid options for traders, that features several sophisticated options to customize your trading experience. As of right now, until I Am Mastery Academy releases their iTrade software, which is going to be a custom in-house software, which is actually going to be better than TradingView and set up to integrate the strategies, the educators, and the chart on one platform. For now, we can use TradingView, which is the world's best web-based charting software. So TradingView is going to allow you to do several major things, such as select the trading asset that you want to trade, mark up the chart and interact with the market, apply different indicators for your strategy. You can also receive economic news on if you have paid versions of the TradingView in case you don't want to start looking up news events. You can also create a watch list, which is going to give you the ability to put your favorite pairs on the right-hand side. You can set price alerts and so much more. Now, let me give you guys a quick basic introduction to TradingView right over here. So what I want to do is on TradingView, let's come over to the DXY, since we've been talking famously about the DXY. Let's look at TradingView and let's talk about how to actually use TradingView on a very, very basic level. All right. So first off, when you're coming to TradingView and you have your chart feature open, this is the bread and butter. This is where you're going to be spending 99.9% of TradingView, and all of your options can be accessed from this screen. Now, right above here, you're going to see the current currency pair that you're trading, which is the DXY. And you can choose the different symbols right in this search box that you wish to trade. Now, in addition, if you are simply on the chart, you can just type out whatever it is that you want to learn. So whatever it is that you want to look at. So if you want to look at AUD, USD, the pairs will automatically pull up. Now you'll see that there's several AUD, USD pairs, and there are also several different brokers which are providing the price feed. Now, I like to use Oanda as the price feed for all of my currency pairs, due to the fact that Oanda is a regulated broker. So there is a lot more accurate price readings on the Oanda, but it's not limited to. You can choose Forex, or whichever ones that you choose to look at. They're all going to do the same thing, with the exception of maybe, the market moving and wicking around 1 to 2 to 3 pips. All righty. Now, from here, you can also predetermine the time frame in which you want to trade and look at the chart. So you can choose your options from the second going all the way to the monthly, and you even have the option in some cases to actually customize which time frames you want. So if you want an 8-hour time frame, you can actually just put 8, add the hours, and then add it to your list, and it will pop up if the time frame you're looking for is not here. You can also choose your candlestick types, and some of the most popular candles are the regular candles and the Hikinashi candles. Many people also use the line chart as well to interpret price readings. Now, my personal favorite type of candlestick pattern is the Hikanashi candle, as the Hikanashi candle helps drown out the noise and helps me better understand trends in the market, which is what I want to trade and capitalize on. Right? You have the option to actually compare certain currencies. So we talked about currency correlations in our previous bootcamp training, and you can pop up currency correlation pairs. Like let's say we go to Euro USD, and let's say I want to pop up Euro USD, it will actually give me the Euro USD right over here. And now I can now actually look at the correlation. It's almost completely identical, like a mirror. Okay. And you can actually mark up your chart and then look for your entries based on these currency correlations, or look for opposite correlations, or whatever it is that you want to do, as discussed on our previous bootcamp. All right. You have the ability to choose several different indicators. So if you're trading with a particular educator and they have an indicator template or an indicator based strategy, you can add these indicators to your chart. Now, once you add the indicators to your chart, you actually have the ability to do something known as, right? Let's come to templates. You have the ability to actually save the indicator template. So if you have different indicator templates or different type of strategies, you can name them here, and then you can just preload them on your chart within 2 seconds, which is exceptional. Right over here, you do have financials. So if you're looking at different financial statements or different economic news events to pop up down here below your chart, that would happen by you selecting which financial news that you want to put. So as an example, we talked about the grade 8. You can look for the grade 8 here and only show those news events so you can know exactly when they're coming up, which can be exceptional asset to you trading. Now you also have the addition to set alerts. Now alerts work in several different fashions, and alerts can help you come back to the chart when you're away from the chart. So as an example, if I wanted to wait for the DXY to reach this particular high right here in the market, and I'm saying, hey, listen, I believe that the market is going to come back up to this high point and drop off. But you know what? The market is not here yet. So I'm going to have to set an alert. And all I have to do is come over here to this line, create an alert, right? And you see everything is already predetermined right over there. So the option is I want to see when the market is crossing, less than, moving up, moving down, etc. So let's say I want to say when the market is crossing this trend line. So that means that the first time that price, pardon me, hits this trend line and crosses it just a little bit, and an alert is automatically going to trigger, and then that alert is going to pop up on my app or on my phone. Now you can choose to download the TradingView app and you can get notified on the app. You can choose you can also choose to show a pop-up. You can also choose to show a pop-up where if you are trading on another pair and this does it, it will alert you, and then you can know to go back here. You can choose to send an email. So if you have a predetermined like trading email or business email, you can send the alert to the email. Now, in addition, which you can look up later down the line, you can also choose to send an alert directly to your phone. So you can actually set up in the settings options, which I'm not going to show you right now, you can actually set up the alert to go directly to your phone. And that's how I have my alerts set up, because it allows me to never miss an alert. But if you don't want them on your text messages, simply download the TradingView app and the alerts will pop up on the TradingView app and show up in your notification history, which is absolutely exceptional. All righty, ladies and gentlemen, when you're testing out your strategy, you can choose this. You can click this replay button, which will just, it would basically erase the market up until a specific point in time that you're looking for. So if you're beginning to test your strategy and do different things like that later down the line, which you will be doing, the best thing to do is not to see what the market is doing, but to create a market replay. and then you analyze the market and allow the market to make its move. So you can see how well you are performing in the market on your own. Alrighty. Now you can also come over here. You can set up and customize your chart. What is showing, what is not showing, the color of the chart, the color of the candles, etc. And you can also take screenshots of your chart if you want to be able to share your chart with other individuals. Alrighty. Now on the right-hand side of your screen over here, you can also create something known as a watch list. A watch list are each of the different currency pairs that you like to pay attention to. Now, what I have done is I have put some of the most volatile pairs that I like to trade and pay attention to. Like I like to pay attention to the DXY because it's the dollar index. I like to pay attention to gold, US 30, and Bitcoin. I trade these often, so they're all at the top of my list. And then in addition, I have each of the major and minor currency pairs, right, in a specific order right below my screen. So I have all the USDs, AU, EU, GU, NU. I have the base USDs, UCAD, USHEF, UJ. I have the ORs, the ORD CAD, ORD SHEF, or JPY. So it just helps me keep my pairs organized, and it allows me to just quickly pick between different pairs. Now, in the event that you're also setting up alerts, you can click right below here, and then it's also going to give you an alert panel, which you can customize, right? So these are each of my pro entry alerts, and this is telling me each of my trades that are currently active. Now, something that's also amazing is that later down the line, you can also, depending on what broker you have, if you have a regulated broker or a TradingView broker, which is paper trading, you can actually connect certain brokers right here to TradingView, and you can trade live from TradingView, which can be very, very exciting. But many people don't use regulated brokers for whatever reason. So just keep that in mind. If you are trading with a regulated broker like Owanda, or I'm not sure if paper trading is regulated, but it must be, right? So Owanda, or if you're trading with Forex and things like that, you can come over here and trade directly from your TradingView, which is pretty cool. And right here on the left-hand side, these are going to be all of the tools that you need to start marking up your charts. And each tool has a little arrow, and you can go through these arrows and then just dive into several different tools to use to mark up your chart. And the best way to learn about TradingView is to use TradingView. So you'll be seeing me marking up my chart and selecting different tools over here to begin marking up my chart. So make sure that you get yourself fully acquainted with TradingView, because this is where you're going to be spending all of your time marking up your charts and creating your price predictions. Now, moving forward from here, we're going to start off or continue today's bootcamp by talking about market structure. Now, ladies and gentlemen, market structure is by far one of the most important aspects of trading within the financial market. Everything in the market boils back down to market structure. All price action readings are based on market structure. All indicators in the market are based on market structure. All strategies are based around market structure. Market structure is the rawest form of price reading. Market structure is essentially looking at the candles right over here and understanding the story that the market is telling you based on reading the information that you see on your screen. So let's get into this. Market structure is a commonly used term by traders who analyze previously defined turning points in the market to understand the market's current trend and make subjective trading decisions based on the recent and actual price movement. Okay? Now, as you see here, market structure can help determine the following. Market structure can help you determine the trending markets. Market structure can help you determine if the markets are ranging. Market structure can help you understand the SRT levels, which is the support, resistance, and trend levels that are being established in the market. And market structure can also highlight areas where there are going to be trend reversals inside of the market. Now, market structure is identified by high and low swing points in the market. So let's take a look over here. What we're going to look at over here is we are looking at basically at a price example. The black line is representing the actual price movement, right? The green and the red candles. So the black line is representing the green and the red candles. What I want you to pay attention to are these arrows, these low and high points. These low and high points are also known as pivot points, or they're also known as swing points in the market. So you are going to label them as lows and highs, but they can be identified as pivot points or swing points in the market. Do not get confused. They are one and the same. Now, the high and the low points is going to determine, the state that the market is in. So let's talk about it. When the market, in this example, we see that the market started off at a low point, and the market began to rally or go up and created a high turning point, right? That's the high point because the market turned around. It created a turning point. It created a high. Now from here, the market began to push down. And as the market began to push down, where it stopped and reversed and turned back up, it created the next low point in the market. Now looking at this, let's look at this. Before the market continued going up, this low point, you have to understand that this is, there's another term which is called a higher low. So if you're looking at this low point, think about it like this. Is this low point higher or lower than the previous low point? And what we can see here is that this low point is in fact higher than the previous low point, which is why it's labeled as a higher low. Now, as we can see that the market began to come up and created a next swing point, it did not go higher yet, so we're just back at the high point. The market pulled back down, it did not go lower, it just came back to that higher low, so we're back at the low point. And then eventually, what happened was the market began to create a new higher high. A new higher high is determined when price is breaking this previous high point right over here. And now what we can see is when this market swung to a new high point, this high point is now higher than these previous highs, which is why we call it a higher high. As the market swings back down, it creates the next low point, which is known as a higher low. And from here, the market is swinging back up, creating a higher high. So as you're looking at this structure right over here, this structure is helping us to predetermine if the market is trending, right? And as long as the market is making a series of higher highs and higher lows, this is what is considered an uptrending market. When the market is in between two high and low points, this is considered a ranging market or a consolidating market. All righty. Now, before we talk about market structure rules, let's come on over to the market and then let's really understand high and low points in the market. All righty. And we're going to understand high and low points by just determining, we're just going to look at this current place in time. So let's look at this over here. Okay. I'm going to go ahead. I'm going to make some bubbles. Not even bubbles. This will be a little easier. I'm going to create little dots. All right. So let's look at these little dots over here. All right. So what we can see here is that the market created a high And then the market pushed down and created, let's lock this up, family. Give me 1 second. Here we go. The market created a high and the market swung down. I'm actually going to zoom in a little bit more. The market swung down and created a low. The low is when the market stopped and reversed and started going back up. The market created a low. Now from the low, the market pushed back up and created a new high point. Now this high point is lower than the previous high point, which means that this is now a lower high. From here, the market continued to swing back down, breaking the previous low and finding a new low point in the market. And this new low point right over here is now considered the lower low because it's lower than the previous low, right? So let me undo this. All right. Now the market is going to continue, as long as the market continues this trend of lower lows and lower highs, the market is in fact in a downtrend. So let's get a little bit busy and then let's talk about this over here. So we have high, low, lower high, lower low, lower high. Right over here, we're going to start to make this black and follow the trend. Lower high. Let's lock this, pardon me. Lower high. 1 second, there we go. Lower high, lower low, lower high, lower low, lower high, lower low, lower high. Still coming, right? This gave us an equal low to this point right over here. So now, here we go. This is where the market paused in trending. So you see how the market stopped at this previous low and began to turn around? Now, as the market stopped and turned around, look at how the market is going low, high, low, high, low. It's not breaking the highs and it's not breaking the lows. So as long as the market is staying within this area, that is known as a range or known as a consolidating market. If the market resumes its trend, then it's going to continue going in a downtrend. Lower low, lower high, lower low. We have lower highs, lower lows, lower highs, lower lows, right over here in the market, right? Now, as we look, we can see that the market actually created a new high, breaking this previous high. Let's take a look. See how it broke that previous high? That's the first sign that the market was going to reverse. It pulled back down and created a new low. Now look at here at how the market is beginning to turn around, right? So what you can notice, if we mark this up on the chart, let's create this. We have a lower high. Okay, and then we have a lower low. So let's keep this over here. Let's X that out. All right. So we have lower high, lower low. Let's duplicate this. The market goes from lower high to lower low, from lower low back up to lower high, right over here, going back down to lower low, over here, going back down to the lower high, right down here, creating a new lower low. I hope you guys are following me. This is how a downtrend is created. As long as this sequence of lower highs and lower lows are being created, this is letting us know that price is still in a downtrend. Now, there's going to be a point where the market is going to turn around. The market turns around when the market breaks its previous high point. When it breaks its previous high point and pushes up here, look at this high point. Is this high point now higher or lower than this previous high point? That high point is higher, signaling that there may be a change in direction because this is now a higher high. And when the market pulls back down and makes a new low, this low is higher than this previous low right over here. So give me 1 second. Right, there we go. Now creating a new higher low. All right. So this is where the market is beginning to change. Now, what ends up happening here is that the market stays in this range. Boom, there's the high point. And here is the low point, right? So we see the market came back to the high point and it turned back around. It did not create new highs. It came back to the high and turned around. Now, when it came back to the low, the previous higher low, and it broke that, what is that now telling us? That is now telling us that this market is going back into a downtrend. And now the market sequence is back into a downtrend. The market has now made a new lower low, and it's now pushing back up, creating a new lower high. And again, continuing this sequence all the way to the point, it's going to continue the sequence of lower lows and lower highs all the way to the point where the market is finally going to reach something known as a base low. Now I'm going to mark this up just so you guys can visually see it. All righty. Now, right down here, what happened in this particular area? The market began to range or give us a sideways movement in this particular area until ultimately establishing a new trend, and then now the trend turning over, going into a bigger uptrend, right? So the market started to go low, high, low, staying in this sideways move. That's called a ranging market, until the market structure officially changed. And now the market went from low, high, higher low, higher high, higher low, right? Equal high, pushing into a new higher low, breaking out, giving us a new higher high, giving us a higher low, giving us a higher high, giving us a higher low, and now we're pushing right back up into the high. And as we can see over here, this market is no longer uptrending. The market is now going sideways. So there goes the high, and here goes the low. And as long as the market stays in between this high and low, this is considered a ranging market. A new trend direction is going to be formed when the market breaks out on either side. All righty? So before we get into market structure rules, one more time. The sequence of lower lows and lower highs will help you visually determine if the market is in a downtrend, okay? An equal amount of lows and highs in the same area predetermines a range, and a sequence of higher highs and higher lows helps us determine an uptrend in the market. So if I get rid of everything on the chart, your job as a trader is to be able to see that the market is downtrending on this side, going sideways here, and now uptrending on this side without having to mark up the highs and the lows on the chart, right? Lower lows and lower highs, pardon me. Lower lows and lower highs on the left-hand side, higher highs and higher lows on the right-hand side. Alrighty, ladies and gentlemen, that helps us determine the market structure. Now let's talk about market structure rules, okay? And this is gonna go hand in hand with everything that I just trained you on, but in more detail. So now the space between a high and a low point is considered a ranging market. So as an example, when the market is low, the market swings high and the market swings back low. We now have a predetermined high point and a predetermined low point. As long as the market, as long as price is trading within this range, this is considered a ranging market. This is where scalpers, depending on the time frame, where scalpers are trading, right? This is the range in the market. Now, moving on, these high and low points are also considered the support and resistance levels in the market. So by using these high and low points, you can actually predetermine levels of resistance and levels of support within the market. And this will help you identify where you want to buy and sell inside of the market. So let's come back over here. Let's take a look at the DXY. Okay. Let's take a look at the DXY. We'll look at a previous analysis and a regular analysis. So let's come on over here and let's take a look at these high points in the market. Okay, let's take a look at these high points. So we're going to do this. Let's lock this up. Now remember, the price went from high to low, created a new low point. Now from low, the market went high and created a new high point. These high and lows can also help you determine the support and resistance level in the market, which means that you can take this high point and you can now make a vertical line. You can color it red if you so choose, and that is your resistance. Now, if you come to the low point, this low point, you can also bring out a line and you can make this blue if you want, and this will determine your support point in the market. As long as the market is trading within this area right over here. Okay, let's change this over here, okay? As the area, pardon me, let me get rid of this lock tool. As long as the market is trading in between this point, meaning that the market came down, went up, came down, went up for whatever period of time. Within this period of time, this is known as the market range. If the market is moving sideways in this area, that is known as consolidation or a ranging market. The high of the market is known as a resistance, right? Is known as a resistance. The high of the range is known as a resistance, or what some people call the roof of the range. Okay? While the low point right down here is considered the support, right? And the support is the floor of the range. All righty? Let me unlock this. Give me 1 second, ladies and gentlemen. I don't want to break the training. I just want to make sure that this is accurate. So this is considered the resistance, which is the top. The support is considered the floor. Okay? And then this is how we determine levels of support and resistance. Now, support and resistance levels change based on the time frame that you are looking on. If you're on a small time frame, you're going to see small highs and lows, giving you small areas of support and resistance. And if you're on higher time frames, you're going to see bigger swing points, giving you bigger areas of range. And as we progress in different boot camps, we're going to elaborate more on support, resistance, supply and demand, key levels, and ranges. But now let's come back over here. Okay? So as long as price is within this high and low point, one more time, that's considered a range. These high and low points help us determine support and resistance levels in the market. Now, when price breaks out above or below the market or the trading range, breaking its previous high or low points, this helps to identify the trend of the market. So as an example, right, I hope this starts to click. In this trading range, the market created the high and the market created the low. And as long as the market is trading in here, the market is moving sideways. Now, eventually, the market is going to break its previous high or low. The previous high was that high swing point. The previous low was that previous swing point. When price begins to break out above, when it breaks out and it closes above the previous high points, this is one of the first signs that the market is going to continue in that direction. So if it breaks above the previous high, the market is looking to make newer highs and continue in an uptrend. If the market breaks out the previous low, it's looking to make new lows and continue in that low downward direction. All righty? So as an example, this is how we're determining the trend that you see right over here. So what we can see is, let's turn this line black. Bingo, right over there. What we can see over here is that the market broke the previous low. By the market breaking this previous low, by the market breaking this previous low in price, see how the candles broke below and closed below? Over here, this previous low, this is determining that price is going to continue in a downtrend. And now price is going to find a new level of support, okay, and create a new lower low in the market. Now let's come back over here. Price will often, not always, retest its previous high or low point to establish a new high or low point in the market before resuming its trend, right? So as an example, let's talk about this over there. Price will often, not always, retest the previous high or low point. So again, when the market is low and the market is beginning to trade up and it breaks the previous high point, right, which is this red line, it breaks that previous high point, creating that new higher high, price will often pull back down right over here, because it has to eventually, what goes up must come down. It has to eventually pull back down to create a new higher low in the market. And when it pulls back down, it will often, not always, pull back down to this previous high point in the market, right? Before resuming its trend. So let's take a look at the live market setting. We can see here that the market broke before its previous, we see that market broke its previous low, setting a new low. And from here, the market pushed back up, creating that new lower high, resuming that downward direction. That new lower high happened to be right in the same area of the previous low, right? Giving us something that we know as a breakout and a retest in the market. And you will see the market often do this. So let's take a look. The market has a new high. The market has a new low. That's the trading range. Market broke out of that low, created a new lower low, pulled back, created a new lower high, That lower high ran into the previous low. Now we have a new range. There goes the new range. In this new range, the market broke out of the previous low right over here, creating a new lower low. The market pulled back up, creating a new lower high. That lower high retested that previous low. So as you see, this is all connected within the market. So this is why many traders, when they are trading price action, right, or they're trading market structure, let me try if this computer can stop freezing up. Give me 1 minute. Let's come down here. Let's look at the market structure right over here. Okay. This is why when traders are trading in the market, what they will do, again, technical analysis, they will look at these previous points. I'm gonna mark these up. Okay. They'll look at these previous points of lows and highs, market making these highs and market making these lows. They will look at these previous points of highs and lows, and these high and low points will start to become the new areas of support and resistance inside of the market. So when the traders are trading, can you see right over here? Take a look. I want you guys to take a close look. As we set the high, as we set the low, and as we set the new high. Look in this previous area. Can you see here how the market was uptrending? Okay. And can you see over here how the market began downtrending right over there? Let's make that red, right? Now, as the market began to uptrend and downtrend and creating these new series of highs and lows, look at how they are commonly retesting each other. Market made a high, market made a low, market created a new high, market created a new low, pushing into the previous lower high, market made a new high, market made a new low, pushing back into the previous low, right? Market pushed up, still trading within the range because it did not create a new high. Market pushed down, creating a new low, which is higher than that previous low. Market pushed up, created a new high, continuing its highs in the directions. The market came down, right? Still creating higher lows. But now the market failed to make new highs right over there and started to come down and make new lows down here, which could be the potential for a downtrend. But ultimately, remember, we're still in this trading range. This was the major trading range right over there. So as long as we're within this trading range, we're still considered in an uptrend. And what ends up happening? The market begins to resume the higher highs, higher lows, higher highs, higher lows, higher highs, running back into these price ranges, higher lows, higher highs, higher lows, higher highs, higher lows, trading in a price range until ultimately creating higher highs, right? So if you can successfully, right? If you can successfully identify the structure and get good with looking at the structure in the market, you're going to seriously become a wizard at trading in the market, because the market is always doing one of two things. The market is either uptrending or the market is downtrending. And the market structure is going to allow you to know, well, when is the market uptrending and when is the market actually downtrending in the market? All righty, ladies and gentlemen. 1 second here. All right. Now, moving forward in the market, now that we understand market structure rules, okay, let's talk about determining trends. All right. Now, hold on. Let me see something. Where is, okay, that was the reversals. All right, so now moving forward, let's talk about determining trends in the market. Now that we understand how a sequence of highs and lows can establish an uptrend or a downtrend, let's begin to put some to put something more physical on the chart to help us understand these trends. And this is where trend lines come in, or determining trends in the market. So again, trends are determined by a repeated series of highs and lows in the market, right? A series, write this down in your notes, a series of higher highs and higher lows forms an uptrend, while a series of lower lows and lower highs forms a downtrend, right? Now moving forward, trend lines are established by connecting two swing points, by connecting two high points or connecting two low points in the same direction, right? Price is often considered in an uptrend if it's above the trend line, and price is often considered a downtrend if it's below the trend line. All right, ladies and gentlemen, so if we look at over here, look at how the market was creating. Remember, the black line represents the price. So what we can see over here is that price is creating a series of lows and highs, higher lows and higher highs and higher lows and higher highs, which means that this is in fact an uptrend in the market. Now, what traders will do to create a trend line is traders will connect two, in an uptrend, will connect two low points in the same direction to establish an uptrend. So they'll take the first low point and they'll take the second higher low and they'll connect that to make an uptrend in the market. And as long as price is above that line, they would safely say that, okay, the market is in an uptrend. All righty, let's come over to the market. Let's try to take a quick look at this. Okay, they would say that the market is still in an uptrend. Let's delete all of this. Let's delete all drawings. Let's come back over here and let's take a look. So 2 points in a higher direction. Again, here goes one low point. Here goes a high point. Here goes a higher low before the market turned around and started going back up. All right. So what we would do, or what a trader will do, is they will connect the wick or the body of the first low point to the wick or the body of the second low point. And this right here will help the trader create what's known as the trend line. So let's come over here, and the trader will believe, one second. Okay. And the trader, one second here. Okay. And the trader will take this trend line out, and the trader will say, okay, as long as price is above this trend line, I am in an uptrend. All right. Very, very easy to understand. Now, if price is trending back down to a trend line, this is usually considered a counter trend. As an example, we see that the market is making a series of lows and highs forming the uptrend. We see that the price is staying above the trend line. However, at this high point over here, the market looks like it's downtrending. On a smaller time frame or for a short period of time, we can see that the market structure begins to reverse. The market goes from higher high, it creates a new low, lower high, lower low, lower high, lower low, forming what looks like a downtrend, making its way back down to the trend line. If you ever see this happening, this is known as a counter trend. As an example, let's come over here to the market. Let's say we're going to establish another trend area inside of the market, right? So let's say I want to look at this trend area. Now, what I did right here is I created something known as a dynamic trend. What is a dynamic trend, right? A dynamic trend is a trend line or a new trend within the current trend, okay? It's a new trend within the current trend. So the trader is looking at this as being the overall trend in the market. But here we had a very, very sharp point. We had a very, very sharp move in price. And it gave us the ability to connect two additional low points. So we can see low, higher low, low, high, higher low, right down here. So what we did was we connected these two higher low points, and now we created a new trend. So now let's take a look. From here, the market is resuming its trend. All right? From here, the market is resuming its trend, making a new high point, making that new higher high in the market. Now we can see that eventually the market pulled back down, creating a higher low, and then the market continued to push up to create a new higher high in the market. But for a short period of time, what we can see right over here, for a very, very short period of time, what we can see right over here is that the market, let's make this red, the market over here started to reverse the market structure. The market went from high to low, lower high, lower low, lower high, lower low, equal high, equal low, pardon me. And it started to form what looked like a downtrend for a specific period of time, right? Traders will look at this specific area as a counter trend inside of the market. And they will not determine that as an actual downtrend until certain market structure characteristics take place, which is known as a market structure reversal. And we're going to be getting into that. Alrighty. Now, coming back over here, let's understand this. Trend lines are subjective. They're subjective, meaning that trend lines are going to work for you the way that you make them work for you. It's not something that is permanent in the market. However, or let's talk about this, trend lines are powerful and are multifunctional. So you can use trend lines in a very, very, very powerful format. As an example, if we're looking at the trend line, remember we're talking about how when the market is in an uptrend, it's breaking previous highs and it's breaking previous lows. Well, the market can also break trend lines. So as you see over here, the market actually broke out of that trend line right down there. So by breaking out of that trend line, that is suggesting to a trader that, hey, this market might start coming down. This market might start being bearish. And now as we can see this right over here, the market pulled back to the last high point. Now remember, as long as price is within a price range, right over here, as long as the price is within a price range, okay, this is trading support and resistance. You're selling at the high, you're buying at the low until a new high or low point is established. So what ended up happening over here is when price came back to the resistance, price came back to the previous high, because price was under the trend line and the price began to reverse, this could have been a very, very great opportunity to create a sell analysis in the market. Now, in the future and in future boot camps, we are going to be discussing entry points in the market and exactly where to locate entry. But right now, that's not the conversation. Right now is you simply understanding the highs and the lows in combination with trends and support and resistance levels, okay? So trend lines can be very multifunctional, okay? But they can be misleading if not used properly. So this is why you want to use trend lines in combination with market structure. So if I am trading a trend line and I am trading market structure, then what I'm looking for over here is I'm not only looking for a price to be under the trend, I also want to see price begin to create new lower lows and new lower highs before I can fully determine that the market is actually going in a downtrend. All righty. Now this is going to bring us to some other things. Right now, you can also use moving averages. All righty. Moving averages is, let's talk about this. Moving averages are extremely popular indicators which help determine the current trend in place of a trend line by averaging the overall number of bullish or bearish candles in a specific period. So you're going to notice that many traders may use moving averages, right? So moving averages include the moving average, the smooth moving average, the exponential moving average, and different variations such as the McGinley dynamic. I use the McGinley dynamic. Okay, so let's come back over here and you'll see that while a trend line is fixed, depending on certain points, a moving average is more loose flowing, and it's not something that you have to mark up on your chart. It's something that is there. So as an example, let's come over here and then let's take a look at a bunch of different moving averages. All righty, I'm going to remove this drawing tools and let's take a look at these moving averages. And I have several moving averages. Okay, the purple is the regular moving average. The purple is the exponential moving average. The blue one is the, this is the exponential moving average. The blue one is the regular moving average. The orange line is the smooth moving average, and the black line is the McGinley dynamic. Now, if you look at this, right, they're all pretty close and related. And you'll notice that depending on which moving average you use, some are going to just, it really depends on the time frame that you're working out on. So let's really talk about this, right? Let's say I want to come over here and I want to look at a moving average and I want to use an EMA. I know EMAs are very popular, or let's use an SMA. Right, a smooth moving average. What you can do is you can put in a period of time in which you want to determine the trend of the market. So if you want to see over the last, now we're on a 2-hour time frame. So on a 2-hour time frame, if we put a 50 period moving average, then that means that over the last 100 hours, if it's above the moving average, that's going to tell us that price is technically still in an uptrend. If we change it to 100, then that means that over the last 200 hours, because this is a 2-hour chart, right? So it's going to take every candle, right? It's going to take the last 100 candles of the current time frame. So on a 2-hour time frame and having a 100 EMA, this means according to the last 200 hours in the market is still considered in an uptrend as long as it's above the MA right over here. Now you can use a huge combinations. You could use the MAs, the EMAs, the SMAs, the McGinleys in a huge combination. Ultimately, this is how traders use moving averages. A fast moving average is used for something known as entries in the market. So again, we're going to be talking about entries later. But you can take a moving average example. Let me take the McGinley, and let's say I set this to a period of 4. That is telling me that over the last, couple of hours, if it's above the 4, it's in an uptrend, and if it's below the 4, it's in a downtrend. So what traders will look for is if they're using a fast moving average, they'll look for when price crosses over the moving average. And when price crosses over that moving average, this is the first sign to a trader on using basically on a trend basis that the market is now going to start coming in a downtrend. And as long as the market is below that 4, it's in a downtrend. until the market crosses back above the 4, which then goes back into an uptrend. And then it closes back below the 4, which then goes back into a downtrend. All righty. This is what traders are using fast moving averages for. Now, traders use slow moving averages to determine the overall trend in the market. So as an example, right, let's get rid of these. Let's get rid of the MA, the SMA, let's just keep the McGinley. I did that by accident. Let's put the McGinley at a 50, right? So now we're using the 50 McGinley right over here to determine, okay, is price in an uptrend? Right? So instead of taking your trend lines and doing something like this and creating that first trend, or using or coming over here and then trying to create another trend over here as an example like this, right? The MA or the moving average of your choice is going to help you basically determine the trend. And this is telling us that based on the past, 50 bars or the past 100 hours, this market is still technically in an overall downtrend. And that's because we're looking at it on a higher time frame. Now, many traders use, and the most powerful way to use trend lines is to use it in combination with moving averages. So you'll notice that there are going to be some points in the market where the market will retest both the moving average and retest both the trend line. By retesting both the moving average and retesting both the trend line at one point in time, that's going to help us understand or establish that, okay, this is a very strong point in the trend and there might be a nice price reaction. Okay, and we're going to be getting more into that. We're going to be getting more of that into the future. Now let's wrap this up with market reversals. Now that you guys are understanding high and lows, how high and lows establish trends, ranging markets, counter trends, things of that nature, let's talk about market reversals. Market reversals are extremely important. So a market reversal is when the direction of a price trend has changed from going up to down and vice versa. And there are specific rules right here. So once again, a market reversal is when the direction of a price trend has changed, going from up to going down. The market structure reversal is going to be your key to unlocking the earliest trend reversals in the market, resulting in you capitalizing on bigger moves in the markets. Okay? And this is extremely important because remember, the markets, pardon me, let's come back over here, right? The market is always doing the same thing. It is coming up and the market is coming down. All right. So when that market changes directions, as an example, that this is a big market structure reversal. When the market structure first changes, you'll have the earliest opportunity to get into a trade all the way over here, allowing you to potentially capitalize on this entire downtrend in the market. Up until the point where the market then goes into a state of range, and then the market, pardon me, the computer is lagging. One moment, family. And then over here, the market is now ranging, the structure is reversing, and now you can find the earliest. Give me 1 second over here. It's a bit ridiculous with the computer, right? And now the market from here is now going in an uptrend. And you can catch the earliest sign, resulting in a longer, stronger, more profitable move in the market. Now, before I talk about market structure reversals, please remember on our previous bootcamp, we talked about time frames. And in addition to talking about time frames, we're also talking about trend and market structure reversal. So let me show you how you can do something amazing. Let's say the market, this is what the market does. It not only allows you to capitalize on early trend reversals, but it allows you to capitalize on trend continuations and things like that in the market. So as an example, if the market is low and the market goes high and creates a lower low and creates a high and creates a new higher low and creates a new higher high and then creates a new higher low. If we're looking at this area, let's take a look. Let's come over here. Okay. If we're looking at this area of high and low right over here in the market, remember, we now have a range. The high of the market is the resistance. The low of the market is in fact the support, right? Now, if this market is in an uptrend and you want to continually trade in the uptrend, how could you get back in? Well, by using market structure, when the market creates a new higher low, the higher low, in order for the market to create a higher low, the market has to turn around. It has to swing. The market has to turn around and start going up. How do you know that the market is turning around and swinging and going back up? Well, what you can do is you can now zoom in on the time frame, right? You can now zoom in. So let's, let's highlight this consolidation zone right over here. And then let's go all the way down to the 15-minute. And let's revisit that area. Now, revisiting this area, okay? Revisiting this area, look at this. Revisiting this area, look at how the market, again, created that low point. From here, the market created a high point. And from there, the market came back to a low point. One second. And now the market here came back to a low point. On a lower time frame, we can now use the market structure reversal. Remember, there is that thing called the multi-time frame analysis where you're using multiple time frames. So if on a higher time frame, this market is uptrending, you can come to a lower time frame and you can also say, okay, is this market uptrending? Well, let's take a look. The market goes from low, high, higher low, boom, creates a higher high, breaking the previous high point, giving you the first sign that the market is going up, pushing back down, giving you a new lower high, now even trading above one of your trend levels, right? Bingo. Here's your earliest sign of a market structure reversal, and this gives you an opportunity to jump into the trade there and continue to take that market up. So you see, market structure is extremely, extremely, extremely powerful. So let's talk about the market structure rules. All righty. There are basically 3 signs of a market structure reversal that you want to commit to your memory. So let's talk about this. The first sign of a market reversal is when price breaks its previous low or high in the opposite direction of the trend. Again, the first sign of a market structure reversal is when price is breaking the previous high or low in the opposite direction of the trend. Example, let's look at the uptrend over here. The market is making low, high, higher low, higher high, higher low, higher high, right? This is the current direction of the trend. The current direction of the trend is bullish. The first sign is when the market breaks the previous high or low in the opposite direction. So if this market is coming in an uptrend, the previous low, right, would determine if the market may start downtrending. So when the market started coming down and it broke the previous low in a downtrend, it now created a new lower low. By breaking that previous low, that is a very, 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 very first sign that the market may very well, in fact, reverse. The second sign The second sign of a market reversal is when price pulls back. Pardon me. The second sign of a market reversal is when price pulls back and fails to create a new high or low point in the previous direction of the trend. So as an example, the market is going low, high, higher low, higher high, higher low, higher high. The market stops this direction by breaking the previous higher low. It comes down and makes a new lower low, giving us the first sign that the market is reversing. Now, when the market pulls back up, it has the opportunity to create a new high point. Now, this new high point, if the new high point is below the previous low or is equal to or below the previous high and begins to come down, this is the second sign that the market is beginning to go in a downtrend. What would make this invalid is if the market makes a lower low, but then as the market pushes up, the market would actually go past the last higher high and make a new higher high. Then all this would be is just a pullback or a deep type of correction. And it's continuing to go higher high. But if the market makes a new lower low and the market pulls back up, creating a new lower high below the previous low and the high, this is the second sign that the market is beginning to reverse. Now, the third and final sign of a market reversal is when price breaks the new lower high in the direction of the new trend. So what we can see over here is that price went from high, lower high, lower low, lower high. And now if the price comes down and breaks that new lower low, creating a new lower low, this is the third and final sign that, okay, this market is definitely reversing and it's now in a downtrend. So these are the three signs of a market structure reversal. Let's bring this over to the chart and show you some live examples and we'll wrap up today's bootcamp. Okay. Let's remove each of these drawing tools. All righty. So that is a live market. This is on a smaller time frame. We can use that. All right. We're going to use these two market structure reversal points over here. Now, mind you, market structure reversals can happen on any time frame. So let me draw out this diagram for you guys here. If you're on, let's say, a 4-hour trend and you see that the market is going from high to low to high to low, right? And you know, making an uptrend on a higher time frame, right? The market structure reversal is going to happen at each of the swing points. So you can actually zoom down into a lower time frame. I'm just going a little slow because my chart is lagging, right? You can go down into goodness. Okay, you can go down to the lower time frame and you will be able to find a market structure reversal at each of the swing points inside of the market. All righty, so every single place where you are expecting the market to stop and reverse is where a market structure reversal needs to take place to continue, you know, to go in that new direction. All righty, that should make sense to you guys. And as you guys continue to develop your trading skills and styles and technical analysis, you'll learn where to identify these higher lows on these different time frames. All right. So let's take a look. So let's say we're looking at the market over here. The market, we're going to talk about the 3 steps. So the market is coming in a downtrend, making a series of these lows, making a series of lower highs, lower lows, lower highs, right? Equal lows, lower high, lower low. Now, if you look at this over here, okay, ladies and gentlemen, if you look at this, here goes the high point, and here goes the low point. The first sign that the market structure is reversing is when the market breaks the previous high. That was the high point. When it breaks the previous high, that's the very first sign that the market structure is reversing. The second sign that the market structure reversing is now that this market has created a new high point, when the market pulls back down. If the market does not create a new lower low like this, if the market does not create a new lower low and break this low, okay, then this is a sign that the market is going to begin reversing. So if the market pulls back and retests the previous high, or pulls back lower and creates a new higher low in that area, or even if the market pulls back down to the low and begins to push back up, this is the second sign that the market structure may be reversing. Now, the third sign is when the market breaks the new high point in the market. So again, this was low, this was the high, this was the low. The market made a new higher high, now reversing the direction of the trend. And as price continues to pull back, it's still considered in a correction. But if the market breaks that new high point like it did right over here, then that is the third sign. Boom, price broke above. That is the third sign that this market is definitely reversing. And bingo, there goes your buy opportunity there. The price pulls back over here, and you have your next trading opportunity giving you your next buy right over there. All righty? And the market is going to do this and continue its direction in an uptrend, or create a market structure reversal and change the direction of the uptrend. Then it's going to do it in a downtrend and continue that formation until it changes the direction in the downtrend. So everything really boils down to market structure, ladies and gentlemen. All righty? So with that being said, guys, we're going to get ready to conclude the FRX Beginners Bootcamp Part 3, and we're going to be moving on to the FRX Beginners Bootcamp Part 4.